If you're only trading the big, popular, high-volume cryptocurrencies, you are absolutely leaving money on the table. You're missing the explosive daily volatility where the real trading profits are made. See, everyone tells you to follow the money, right? Go where the volume is. But what if that's the exact opposite of what you should be doing?
And there's the twist. The idea that a ton of volume is actually boring? It sounds totally backward, I know, but it's the key to a strategy most traders completely overlook. High-volume coins, they're like cruise ships. They're stable, they're slow, and they take forever to turn. We're not hunting for cruise ships, we're hunting for speedboats. And by the end of this, I'm going to give you the exact step-by-step playbook to find them.
All right, here's the game plan. First, we're going to bust this high-volume myth wide open. Then we'll get laser-focused on our real target, volatility. After that, I'm going to walk you through the exact screener setup to find these potential gems, show you how to pick the right charts just by looking at them, cover the must-know risk strategy, and then wrap it all up with a trader's final rules. Let's do this.
So seriously, why is trading the big names like Bitcoin or Ethereum a flawed strategy for active traders? Well, it all comes down to sheer size. When a coin has a massive market cap and billions of dollars in daily volume, it takes a staggering amount of money to move the price even a tiny bit. That's great for stability, sure, but for a trader who needs action, it's terrible.
Just look at this comparison, it makes it so clear. On one side, you've got your high-volume coins. Think Bitcoin. How often does Bitcoin really swing, say 10% or more, multiple times in a single day? It's incredibly rare. The thing is just too big. But then you look at the other side, these low-volume gems. They have small market caps, which means they're nimble. Even small amounts of money can cause these huge price swings, and that creates the high-risk, high-reward playground that traders really thrive in.
And that brings us to the absolute heart of this strategy. We're not hunting for the next revolutionary blockchain or some amazing tech. No, we are hunting for one thing and one thing only, volatility. For a trader, volatility isn't some scary word you need to avoid. It's the raw material we use to make a profit.
And that's really the crucial point here. Without those price swings, both up and down, there are no trades to make. A flat chart is a dead chart. It's useless to us. Volatility is what creates the peaks and the valleys that we can trade between. Our entire mission is to find the assets that give us this day in and day out.
So this is the simple, powerful truth at the center of it all. In a low-volume market, there just aren't that many orders on the books. So a single, decent-sized buy or sell order doesn't just get absorbed by the crowd. No way. It can single-handedly shove the price way up or way down. That lack of liquidity, that's the engine that creates the volatility we're looking for. So, okay, let's turn this idea into action.
All right, enough theory, let's get our hands dirty. How do we actually find these coins? This is where we get super practical. We're going to use a market screener, like the free one on TradingView, to sift through hundreds, even thousands, of assets and pinpoint only the ones that fit our very specific high volatility profile.
And it's just 3 simple steps. It's beautiful. First, you're going to pick one exchange to focus on. We'll just use Bybit for this example. Second, and listen, this is the magic key right here. Set the 24-hour volume to $1 million or less. That one filter instantly gets rid of all those slow-moving cruise ships. And finally, we want coins that are already in play, so we filter for a 24-hour change of at least 10% up. And boom, this is the power of that simple filter. On Bybit, for example, doing this takes you from a totally overwhelming list of 485 symbols down to a clean, super manageable list of just 13 potential candidates. Think about that. We've just cut out over 97% of the noise, leaving us with a curated watch list of coins that are already showing signs of life. But hold on, the screener, that's just the first cut. It gets us in the right neighborhood. Now comes the most important part of the entire process, and it has nothing to do with numbers or fundamentals. It's all about visual pattern recognition. It's all about the shape of the chart.
I absolutely love this quote because it just nails it. You don't need a PhD in finance for this part. We don't care about the coin's groundbreaking tech or its world-changing mission right now. We are simply looking at the picture, and we're asking one question. Is this a picture of predictable movement, or is it a picture of pure chaos?
So what are we looking for? Simple. On the left, this is what you avoid. See this? A chart that has just fallen off a cliff, a straight line down. Trying to trade that is like trying to catch a falling knife. Don't do it. But on the right,
Now that is our ideal candidate. It's a chart that's moving up and down inside a predictable range. It bounces off a clear support level and hits a clear resistance level again and again. That is a chart you can milk for repeated gains.
Okay, we need to be crystal clear about something. This is a high-risk strategy. These are not blue-chip investments you tell your grandma about. They are volatile. They are small-cap assets. So managing your risk isn't just important, it's literally everything.
And the number one tool for managing this risk is dollar cost averaging, but we're using it as a trading tactic, not a long-term investment strategy. Here's what that means. You never, ever go all in on your first entry. Instead, you go in with just a small piece of your capital and you keep the rest ready on the sidelines. Why? So you can average down, buy more at cheaper prices if the chart moves against you before it makes that bounce you're waiting for.
And let's be totally blunt about why this is mandatory. There is zero guarantee that any of these coins will bounce from support. Some of them will just keep falling. And yeah, some might even get delisted from the exchange and go to zero. It happens. DCA is your safety net. It's what allows you to survive those drops and still be in a position to capitalize when the bounce finally comes, without blowing up your account on one bad call. So, you've done it. You found a low-volume gem, it's got a beautiful chart shape, and you've got your DCA strategy locked and loaded. Before you pull the trigger, let's just go over the final, essential rules that make this whole thing work. This is the insider's playbook.
Okay, rule 1. Remember, this is trading, not investing. We are not marrying these coins, we're just milking them for volatility. Rule 2, DCA is not optional, it is mandatory. Rule 3, and this is a really cool bonus, a lot of these little coins couldn't care less what Bitcoin is doing. They move to the beat of their own drum, which means you can find opportunities even when the whole market is bleeding. And the final rule, this is the unwritten one. When you find a great chart, keep it to yourself. If you broadcast it, you attract more volume, and more volume can kill the beautiful, predictable volatility that you were trying to trade in the first place.
You know, the vast majority of traders are all crowded around the same handful of popular coins, all fighting each other for tiny little percentage gains. But the real action, the truly explosive volatility, it's often happening in these quiet corners of the market that almost everyone else ignores. So the only question left is, are you willing to be one of the few who actually goes to look for it?
Stay ahead in the crypto market. Subscribe now for the latest global news and updates.